Okay, so in early 2026, if there's one market that has absolutely everybody talking, it's silver. I mean, after years of being pretty quiet, it's suddenly on fire. The prices are soaring to levels that are just shattering old records. So we're going to break down exactly what is going on, and more importantly, why. Get this. After an absolutely blistering 160% rally through 2025, silver just blew right past a new all-time high. It crossed that huge psychological line of $95 an ounce. The momentum is it's undeniable, and it's making everyone, from seasoned traders to everyday people, stop and pay attention. But this isn't just about a number on a chart. Analysts are saying that silver has fundamentally changed. It's not just some industrial metal anymore. They're calling it geopolitics in metal form. Basically, with all the uncertainty in the world, there's a mad dash for physical metal, and it's literally draining the vaults in London and New York. Silver has become this kind of barometer for how anxious the world is feeling. And that right there brings us to the $1 million question, or maybe the $95 an ounce question. Are we just watching a classic speculative bubble inflate, getting bigger and bigger right before it pops? Or is this whole rally built on a solid bedrock of real structural change that's actually just getting started? Let's dig into both sides of that argument. Okay, so first, let's play devil's advocate. We have to look at the case for a crash. Because despite these record-breaking prices, there are some classic warning signs flashing that suggest this whole rally might be built on some pretty shaky ground. So the biggest warning sign that traders are pointing to is something called bearish divergence. Now, in plain English, all that means is that even though the price is hitting new highs, the actual strength, the momentum behind that price is getting weaker. It's kind of like you're flooring the gas pedal in a car and the speedometer is climbing, but you can hear the engine starting to sputter. It's a sign that things might be running out of steam.
And what's really telling is how all these signs are happening at once. First, you've got that weakening momentum we just talked about. Second, something called open interest, which is basically the total number of bets on the table in the futures market, is actually falling. That's a huge clue that the smart money, the big, sophisticated traders, are quietly cashing in their chips. And third, you've got financial heavyweights coming out and publicly warning that, hey, this thing is getting way too hot in the short term. When you put those three things together, it really does paint a cautionary picture.
But hold on. Before you run for the hills, let's flip the coin and look at the other side of this argument. The side that says a major crash is almost impossible. And this case has nothing to do with charts or sentiment. It's based on a massive structural problem in the real physical world. We are literally using up silver way faster than we can dig it out of the ground. Just look at this number. For 5 straight years now, the world has consumed 800 million more ounces of silver than all the mines on Earth have produced. This isn't a one-year blip. This is a huge accumulating deficit that's draining global stockpiles at a pretty alarming rate. It's like a bathtub with the plug pulled. And this chart really shows you why that deficit is so powerful. See, unlike in the past, a massive 60% of all silver demand isn't for investing or jewelry. It's from industry. This isn't speculative money that can just vanish overnight. This is demand from companies that absolutely need silver to build things like solar panels, electric cars, and all our electronics. And this industrial demand has just hit overdrive. In 2025, the solar and EV sectors just exploded. And remember, an electric vehicle uses almost double the amount of silver as a regular gas-powered car. But the real earthquake hit in 2026. China, a huge producer, suddenly turned around and classified silver as a strategic material and just stopped exporting it. That single move sent shockwaves through the market and has companies all over the world scrambling to find new supplies. So you've got this epic tug of war, right? On one side, you have the technical signals in the paper market screaming that a correction is coming. And on the other, you have this massive physical shortage that's pushing prices up. With the market caught right in the middle, where on earth do the experts think this is all heading for the rest of 2026? Well, the division here is just staggering. On one side, you have the optimists. They believe that physical scarcity is the only thing that matters, and they're projecting prices that sound almost unbelievable, like $175 to $220 an ounce. But on the other side, you have the realists, who argue that, hey, prices this high will eventually just crush demand, leading to a cooling phase that takes the price all the way back down to around $58. I mean, those are two completely different futures. So how are you supposed to navigate a market like this? Well, here's the thing. It is entirely possible for both sides to be right. You could absolutely see a short-term correction based on market sentiment happening inside of a much larger long-term bull market that's being driven by that physical scarcity.
So let's look at a potential strategy for this.
All right, so here's a three-step playbook based on all this analysis. First, probably not a great idea to chase these all-time highs. The analysis suggests waiting for a pullback, with traders eyeing the $80 mark as a key level of support. Second, keep a close eye on the gold to silver ratio. Think of it as a scorecard for which metal is winning. Right now, it has collapsed, which means silver is crushing gold, but historically, that's also a sign that a lot more volatility is on the way. And third, with all these reports of vaults being drained, owning the physical metal itself, or an ETF that's backed by it, is seen as a much safer way to play this than using high-leverage contracts in the paper market.
And all of this leaves us with one final critical question. What we're seeing is a battle between the paper markets, which are driven by sentiment and speculation, and the physical world, which is facing a very real, very quantifiable shortage. So in the long run, when industries need more actual silver than all the mines in the world can pull out of the ground, will the day-to-day games of the paper market even matter anymore? That is the multi-hundred billion-dollar question for 2026.